Let's talk about taxes, but not your taxes. We're talking about how billionaires manage to legally avoid paying what most people would consider their fair share. This isn't about crime, it's about knowing the system so well they play a completely different game. And in this video, I'll explain it to you clearly and simply, because honestly, that's how straightforward some of it is when you break it down. Capital gains versus income tax. Let's say you have a lemonade stand and you make money selling lemonade. That's income, and it gets taxed. But if your friend buys a lemonade stand, holds onto it for a year, then sells it for more money, that's a capital gain. And the tax rate on that is usually way lower. Billionaires like Warren Buffett make most of their money this way by selling assets like stocks, not working hourly jobs. So instead of paying 37% like a high-income employee, they might pay 15% or 20%. Borrow against assets. Imagine you own a huge toy collection that's worth a lot of money. You don't want to sell it because then you'd have to pay taxes. But you still want money to spend, so you go to the bank and say, hey, I've got all these valuable toys, can I borrow money against them? The bank says yes. You now have cash, and guess what? Loans aren't taxed. That's what people like Elon Musk do. They borrow against their stocks and avoid selling them. Real estate depreciation. Real estate investors like Donald Trump use this a lot. Let's say you buy a building. Every year you tell the taxman that your building is losing value over time, even if it's actually going up in price. This pretend loss helps you lower your taxable income. It's called depreciation, and it lets you write off a big chunk of money every year. Offshore shell companies. This one sounds like a spy movie, but it's legal. A billionaire opens a company in a country like the Cayman Islands where there's no income tax. They move their money there on paper, even if they never step foot in the country. Since the money technically belongs to the company in the Caymans, they pay little or no tax in the US. Trusts and foundations. This one's clever. Let's say you want to give away your fortune but still control it. You put your money into a private foundation, like the Bill and Melinda Gates Foundation. You get a tax break for donating it, but you still decide where it goes. Trusts work similarly. They help rich people pass down wealth without massive taxes by placing assets in legal wrappers that skip estate taxes. Stock-based compensation. Instead of taking a big salary and getting taxed at the highest rate, CEOs often ask to be paid in stock options. These don't get taxed until they're sold, and even then they count as capital gains. That's why Jeff Bezos took a small salary at Amazon, but his net worth still shot through the roof. He owned the company's stock. Loss harvesting. This is when billionaires sell their losing investments to cancel out their winning ones. Imagine you got two trading cards. One gained $100 in value, one lost $100. You sell both. Because you lost and gained the same amount, your tax bill is zero. Rich investors use this trick at the end of every year to lower what they owe. Buy, borrow, die. This is the ultimate long game. A billionaire buys assets like stocks or property. Instead of selling them, they borrow against them for spending money. Then they die. When that happens, their kids inherit the assets and the tax basis resets. That means those capital gains just vanish and the heirs pay no tax on them. It's like magic, except it's written right into the tax code.
Step up in basis. This rule allows heirs to inherit property or stocks at their current market value, not the original purchase price. So if a billionaire bought stock for $1 million and it grew to $10 million, when their heirs inherit it, they pay zero capital gains tax on that $9 million increase. It's a reset button for taxes. Qualified small business stock. If a billionaire invests in a small startup and holds the stock for 5 years, they may be able to sell up to $10 million of it tax-free. This is meant to encourage investment in small businesses, but savvy investors know exactly how to structure deals to take full advantage of it. Carried interest loophole. This one's big in the private equity world. Fund managers earn what's called carried interest, a share of the profits they generate for investors. But instead of being taxed as regular income, it's treated as a capital gain, which is taxed at a much lower rate. So a hedge fund manager making millions could be taxed less than their assistant. Deferred tax strategies with life insurance. Wealthy individuals often park money in permanent life insurance policies. These grow tax deferred, meaning they don't pay taxes on gains each year. Later, they can borrow against the policy tax-free, and if structured right, it becomes a tax-free wealth transfer tool when they die. It's like a private bank with tax perks built in. All of this might sound complicated, but it really boils down to this. The ultra-wealthy don't earn money the way most people do. They own things, stocks, property, businesses, and they use those things in smart ways to avoid triggering taxes. Everything they do is legal because the tax code was written with loopholes big enough to drive a yacht through.
If you like the video, give it a thumbs up. It really helps. And if you want more content like this, consider subscribing. Got an idea for what I should cover next? Drop it in the comments.